Hi, I'm Mike Bassito with IM Global Partner, joined by co-founder of DBI and co-portfolio manager Andrew Beer. Thanks for joining our monthly update on the IM Global Partner DBI Managed Futures ETF strategy, ticker DBMF. This is our year-end 2023 wrap-up/2024 year-ahead video update, but we're still going to keep it concise, and we hope you'll find this to be time well spent. December was an interesting month to cap off an interesting year. Challenging for managed futures, but most everything else performed to varying degrees of positivity, with a powerful close to what was another highly correlated year for risk assets, both equities and fixed income. But as always, we're committed to the long game and the need to deliver real diversification to portfolios with what we believe to be a superior mousetrap in the managed futures space. So with that, Andrew, let's get started with your comments on performance, positioning, markets in general, and a broader perspective with what I know will be some thought-provoking points along the way.
Thanks, Mike. So 2024 was a very frustrating year. We ended the year down over 8%, largely caught on the wrong side of the everything rally that began in early November when Powell suddenly and unexpectedly flipped from hawkish to uber dovish. We came in behind both the SocGen CTA index, here and after the hedge fund index, and the Morningstar US Trend Systematic category, here and after the Morningstar category. This is very rare for us. If you look on the upper left, you'll see that we outperformed by 500 to 600 basis points in 2021, outperformed again in 2022, especially relative to mutual funds, to the tune of 600 or 700 basis points, but then underperformed last year. And so for those familiar with our longer-term track record, you'll recall that we also outperformed sometimes by a wide margin in 2016, 2017, 2018, and 2019. So it's atypical for us to underperform like this and frustrating to do so during a down market for the space like last year. That said, and to be very clear, from a replication perspective, we are not concerned about this. Variations like this are natural. Our correlations remain high. And we know from multiple models and sources that we are accurately capturing the core positions across the industry. Those of you who attended our Zoominar in December saw a lot of data on this firsthand. We never argue that replication is a perfect copy. Rather, we say that it's the best way that we found to efficiently get exposure to the overall space. On the macro front, 2023 was a very humbling year for strategists, but a terrific year for investors. Most major consensus themes failed to play out. An early taper. Bonds would outperform equities, Europe would outperform the US, recession by June, value would outperform growth. To the shock of grizzled macro experts, Powell may have pulled off a remarkable feat, the immaculate landing. Inflation appears to be subsiding without the dreaded recession. So he pivoted in early November, the markets took off, then investors raced to rebalance their portfolios before year end, which then added fuel to the melt-up fire. So we had an everything rally, a beautiful sea of green. So this has been wonderful news for investors short term, but raised serious questions about diversification, which we'll discuss in a second. Now, the speed and magnitude of the rise certainly feels to me like the market got ahead of itself, so we'll see if there's a bit of a hangover January. In any event, on the positioning front, we are out of the inflation trade. It took several weeks, but right now we are modestly long the back end. We're also long US and to a lesser extent international developed markets with a hedge in emerging markets. After several volatile months in commodity land, we're flattish both crude oil and gold. Finally, we have some spread trades on in the currency markets. With that, next slide, please. A theme today is what we call the sea of red or green, the idea that stocks and bonds and most asset classes have been moving in tandem. Here's the first one. 2022 was a sea of red. Unless you were in managed futures or commodities and a few other areas, there really was no place to hide. So while we didn't have the 40 to 50% equity drawdown like we had during the GFC, bonds failed to serve as a buffer. And it was a historically bad year for 60-40 portfolios. In essence, as we've argued, the cornerstone of diversification in multi-asset portfolios was upended. So we have some good charts on this on our website, dbi.co, where we walk through how we entered this brave new world on the asset allocation front in early 2022. Next slide, please. And here's the same chart for 2023, a sea of green. But note by the end of October, this picture was much more mixed. Bonds were still in the hole. But the wild rally in the last 8 weeks of the year meant pretty much everything ended up. The winners of 2022, managed accounts and commodities, were both down. Next slide, please. But here's the whole picture. 2022 and 2023 together. This encapsulates both the onset of the hiking cycle and the market's relief rally at the apparent end of it. DBMF and managed futures mutual funds were up 10 to 12%, while equities, including the NASDAQ, which soared 55% last year, just climbed back into the green over the past several weeks. Some equity categories, small caps and emerging markets, are still down a lot. Bonds are down across the board, and REITs have been clobbered. A 60-40 portfolio with the S&P 500 and Bloomberg Ag was down slightly, and those with more diversified equity portfolios likely down more. So let's not let 2 great months at year-end mask how difficult the preceding 22 months were for allocators. Next slide, please. And here's a jaw dropper. This shows the correlation of all those asset classes to the S&P 500 last year. Now, we expect other equity categories to have correlations of 0.8 or 0.9, but bonds broadly had a correlation of 0.84. Corporate bonds and high yield were around 0.9. REITs and liquid alts were there as well. So we've essentially been in that dreaded market environment where it feels like, quote, everything, or maybe almost everything, has a correlation of 1. Meanwhile, managed futures had a resoundingly negative correlation to the S&P 500, and hence to bonds and the rest of your portfolios. So while we're frustrated with 2023, any strategy that was serving as a hedge to equities with a negative correlation should have been down last year when the S&P soared 26%. It's math. Next slide, please. So from a practical perspective, this is supposed to be the point of diversification to provide lower volatility for clients. So what if an allocator decided to go from a 60-40 portfolio to a 50-30-20 portfolio of the S&P 500, Bloomberg Ag, and managed futures at the start of the hiking cycle? Here's that comparison using the SocGen CTA index, the benchmark for the space. Rather than down slightly, the portfolio would have been the green. Volatility would drop by a quarter, and the max drawdown would have been 40% shallower. So this is our point, that managed futures potentially offers a high diversification bang for the buck relative to others. And one more slide on this topic. So here's the rolling correlation of those 2 same portfolios, but extended back over 2 decades. As you can see, the stalwart 60-40 portfolio does go through periods where volatility has risen a great deal, the metaphor of clients strapped onto a roller coaster. Now, CTAs are practically built to help smooth that ride. As we say, if you have a statistical bone in your body and build model portfolios, in our opinion, the question is not whether you should include managed futures, but how much you should allocate. On to the next slide, please. And this is why we like to say DBMF can serve as the 3rd leg of the asset allocation stool. Here's performance since inception versus stocks and bonds. We've generated over 800 basis points of alpha per annum relative to the S&P 500 with negative correlation. When stocks and bonds were rising in 2019 through 21, we were making money. When stocks and bonds went south in 2022, we had our best year. When markets reversed, we gave back some of those gains. So for long-term investors, we think the use case and diversification benefits are very, very clear. And by the way, as a final point, let's put that 800 basis points per annum of alpha in context. The Bloomberg Ag has generated negative alpha of 323 basis points per annum over the same period. The Wilshire Index of liquid hedge fund strategies is at negative 295 basis points per annum. Again, this is the point about bang for the buck, which brings us to the next slide. Here's our standard chart on volatility adjusted positioning. So we've seen big moves in positioning over the past 3 months, not surprising given the moves in the markets. As noted, and starting on the left, we flattened our exposure to commodities. In currencies, we've maintained the same directional exposure, long euro and short yen, but with smaller position sizes today. In rates, we dialed out of the bet on rising or sustained higher rates and are modestly long duration through a yield curve flattener. And finally, we built a spread trade on the S&P versus emerging markets. And that is what managed futures, aka CTAs or commodity trading advisors, are supposed to do. The inflation trade was one of the great alpha generators of the past decade, but all great trades come to an end. Now, we can quibble about whether CTAs held the trade for too long, but the simple conclusion is that this was one of the most valuable places to put capital during the sometimes brutal market conditions of the past 2 years. But when it's clear the big trade is over, and I personally think that's what Powell was saying in both November and December, It's time to move on and hunt for the next opportunity. And that's where we are today, and where we'll be in a year or 5 years from now. As a semi-related matter, I plan to start posting charts and interesting data on a more regular basis on LinkedIn and Twitter this year. Things like that jaw dropper on correlations. So please do connect with me if you're interested in seeing them in real time. With that, I'll hand the baton back to Mike.
Excellent. Thanks, Andrew. So let's wrap here with just a simple long-term performance update. While we did indeed lag in 2023, in terms of annualized results, DBMF continues to outperform versus both the SocGen CTA index and the Morningstar category, beating the former by over 140 basis points annualized and the latter by over 330 basis points annualized. Upon request, we can also provide performance numbers prior to the ETF utilizing historical performance from the SMA version of the strategy. So to sum it up, why DBMF? The strategy seeks to deliver outperformance versus, while closely tracking, the index, which we have done historically, while keeping fees low and single manager risk mitigated via our disciplined replication approach, all in a liquid, easy to implement ETF. So in closing, thanks to all of our clients and to our prospective clients for your confidence and interest in DBMF. If you have more questions about the strategy, would like further information, or a call with us, please don't hesitate to reach out to send us an email at team@imgpfunds.com. Till next time, from DBI and from IMGP, thanks for spending time with us.